first and foremost, the Fed wants to cut. And I know it's popular to try and get headlines to say we're going to get hikes, and that's not going to happen. We're not getting any hikes. So the bond market knows that. So now all they have to forecast is how many cuts do we get? High likelihood that yields are the top is in for the year if oil's top is in. For now, I think you have a kind of a disinflationary chill that's going through the market because of oil and because of what the Fed's doing with bonds.
Hey everyone, this episode is brought to you by Avalanche. Everyone's favorite red coin is a fan of On the Margin, and we are a fan of Avalanche as well. Talked about it on the program before. Avalanche is a very cool solution. Their subnets allow for a very scalable blockchain that's also interoperable at the same time. And it's not just me. The institutions are noticing and they're building on the evergreen subnets as well. You're going to be hearing all about some of those institutions later in the episode. For now, Avalanche, thanks for making this possible. Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions. You're going to be hearing all about them later in the show, but for now, Mantra, thanks for making this episode possible.
All right, welcome back to another episode of On the Margin. Joining me today is Warren Pies from 314 Research. How you doing, Warren?
I'm good. It's good to be here.
Let's get right into it. About a month ago, you had a tweet that really piqued my interest. I'll bring it up here. But you mentioned that you believe that there's a 90% chance that the high for oil was in for the year. And you implied that because of that, the high for long bond yields would be in for the year. I'd love to hear a bit more about what drove that analysis and how to unpack that. And, we're recording this on Tuesday, June 4th, and there's been a pretty consistent pullback in the oil market. So same with yields as well. So this call has so far been pretty correct. And I'd love to just unpack the analysis of what drove you towards that and where you see things about a month later.
The real overarching point, and one of the points that I think has flowed through the entire company with our research company 314, is that oil really touches almost every major asset class, and it's not appreciated by many commentators. I think oil is a really difficult market. If you haven't spent a lot of time modeling it and have like a strong fundamental background there, you tend to avoid it and kind of put it over in the too hard pile, which I get. And I would say even most oil analysts or most oil forecasters are pretty terrible at how they approach the oil market. But I've spent years in that market developing what I think is a superior way to look at it. And so that's number one, is that oil really impacts everything. I make a point about how it impacts break-even inflation, CPI swaps, in market-based inflation expectations is really, when you get to it, what's impacting it is oil and the price of oil. And that's a market inefficiency in a lot of ways. If you can deconstruct those measures of inflation, that's a whole nother side tangent. But it impacts those, and through those, it impacts yields and the bond market. And ultimately, even this year, during this inflationary regime, you've seen oil kind of negatively correlate with the stock market. So the big point to me is that if you can get the call on oil right, you can have you can take a lot of risk off the table across assets. And so let's start with oil. Why did I think that the top end oil was in? Why I think that, first off, just going to say, like, it's a tweet. And, a lot of it is sometimes I just throw what's in my mind out there. I really am not in my own core. I'm not really in favor of making these long-term predictions on the price of oil. That's one of the things I think that's superior about the way we do it, is if you go to every investment bank out there, they're going to have you an average price of oil for the year. And I get it. That's the world we live in. That's how we have to make predictions and stuff like that. But I think it's a good disclaimer to say, hey, like, this is a wild market. And the idea that I can understand all of these things that are so path dependent in this oil market 10 months in advance or something like that is crazy. And so that's the disclaimer. But I think that we hit this peak in optimism. You saw it in the futures positioning. We saw it in coming out of the escalation of the war between Israel and Hamas, and how that could potentially bleed out into involve Iran. And Iran has been a big source of supply during these years where OPEC has continually supported the market through cuts. What we've seen is that those non-OPEC supply has filled that gap. And Iran has been a big part of that, something like 800,000 barrels a day, which is huge. That was the concern that got us to peak optimism in crude oil. And so I saw at that point in time, I was saying for a while, like we thought oil was getting to 90. We came into the year saying we think oil goes to 90 at the end of the first quarter. And our really aggressive call is that we think we end up in the 50s at some point this year in the back half of the year. And the whole reason behind that is that I saw a kind of confluence of events like this. I think that we saw major pessimism coming into the year, the right mix to drive a first quarter rally as OPEC cuts were still in place. But by the second half of the year, I thought OPEC is going to have to reckon with the amount of oil they've held back off the market. And so all those things came to pass. We got into the 90s. We washed out all the short positions, which is really what drives this market. And we ended up in a place that looked very risky for oil. We downgraded commodities. Our commodity index benchmarks the GSCI. It really tracks oil and energy markets well. And so that was that point. I think it was like very early May when I made that tweet, and we made our moves somewhere in mid-April for downgrading. And from that first part of April to mid-April, it was pretty clear to me that we had put in a top for crude oil. It's just a matter of how sustainable that is. Why I thought that it's going to last through the rest of the year is we just came off this OPEC meeting where again, I've made this point, like 90% of analysts expected OPEC to just hold the status quo and support this market and allow non-OPEC supply to continue to ramp up. I talked to big clients and people who are involved in the oil industry, oil traders, hedge funds, and I've had this call with them. One of them, I had a very large name brand fund who is instrumental in the oil markets. I had a call with them back, I think late March, their first quarter call. And they asked me like, what's a trade for the year? And I was basically saying, let's put on a short oil trade at that point in time. And why we walked through the OPEC reasons, some other things that are more technical. And they were like, why would OPEC do that? And the bottom line is OPEC found themselves in this kind of like Chinese finger trap where they have to get that oil back. They're basically ceding market share and they're not gaining on the price. And I think that reality was bound to come to pass. And so this last meeting, I think, is a really big one because it's the first time they've had to break character from we support the market. We're fighting the short sellers. This is what we're doing. We're not afraid of shale. We're not afraid of non-OPEC supply. We do what we want. We run this market. And that's what OPEC had been saying all of last year. That was the regime for last year. And I just knew it was going to have to switch. It's just a matter of when. I thought that the election was the one thing that could delay that coming, because I thought that really OPEC doesn't want to drive the price of oil or doesn't want to let the price of oil drop in front of the election, because honestly, I think they would support Trump. They'd rather have Trump in office rather than Biden. And so this was my frame for oil, not to be long-winded, but I think it's important to understand. And then you go over to the bond situation. We've been bearish on bonds. We were bearish last year. We were bearish coming into the year. We've traded them really well, actually.
What drove that bearishness on bonds?
I mean, number one, I think that no recession. So that's number one. If you're not getting a recession, then you need some kind of value in the long part of the curve to get you involved. And my view is that we had already discounted the entire cut cycle in the bond market. So like if the 10 years at 4.3 or wherever it's at today, and you have Fed funds rate at like 5.5, historically, after a normalized cycle, you see the 10-year about 150 basis points above Fed funds. So it's already basically saying the Fed's going to take 300 basis points off the funds rate to get us to that normalized posture. So we've already discounted the entire cut cycle, and to the extent that doesn't come to pass, or the neutral rate, quote unquote, is higher than people think, I don't think I think that the long end is overvalued versus the short end. That's number one. And then the other part of the bearishness was this mass of supply. We had a $2.5 trillion funding hole that the U.S. government plus QT was forcing the Treasury to fill. And the Treasury has been issuing bills. I know this is a really topical conversation point for macro people, but in my opinion, some people basically dismiss it. And I would say, no, I think the supply argument matters. It does matter. $2.5 trillion a year is a lot. It's more than outside of COVID. It's the largest funding hole we've seen, and it's in perpetuity, and it's during an expansion, not during a contraction when tax receipts are low. So this is not good for yields. It's not good for wanting to float long-term paper to the U.S. federal government, in my opinion. Well, That's the structural bearish argument. Things start getting more bullish this year. Number one, first and foremost, the Fed wants to cut. The Fed wants to cut. So there's still a signal impact. Like once you take away the chance of hikes, and I know it's popular to try and get headlines to say we're going to get hikes, and that's not going to happen. We're not getting any hikes. That's just not happening. So the bond market knows that. So now all they have to forecast is how many cuts do we get? And and so that allows for stability on the top end. And then the Fed sent an important signal. They basically ended QT back in the May. That was an end to QT. Like they tapered more than anyone had thought they were going to. They started it as early as anyone expected. That took 400 billion of that 2.5 trillion supply hole that we talked about off the table. So you had a 20% reduction in the supply that was needed to fund the federal government. Bullish on yields. It's bullish insofar as, we had a 4.7% 10-year when I put that tweet out. Like, where are we going? Like, a 5% basically starts slowing the economy and breaks the back of the economy. I just don't see when the Fed has your back and there's no more cuts, and you think oil is going to do what I thought oil is going to do. High likelihood that yields are the top is in for the year if oil's top is in. That was my reasoning then with the tweet. I stand by it. If you study history, which was the chart we put in that tweet, you just don't have many spikes in the 10-year without a spike in oil. Historically, they happen every once in a while, but in general, oil's on the scene of like all those really nasty things. And if you look back in the last few years, even when we had the 10-year test 5%, all those times we had oil rallying. So if I'm wrong about oil, if oil sells off really aggressively here, if OPEC reverses course, we get a lot of short interest in the oil market. Maybe we reload that gun. But for now, I think you have a kind of a disinflationary chill that's going through the market because of oil and because of what the Fed's doing with bonds.
We believe that oil is generally in a bear trend for the next while. I'd love to shift that into forecasts about inflation, and maybe we can look at that through two different lenses. First off, the headline lens and how energy and lower energy prices might affect that. But also know that you've done a lot of work on some of these stickier aspects of inflation, especially owner's equivalent rent and that lagging indicator, and whether that's actually going to keep trailing downwards or whether we see that accelerate further, and we're not and whether that leads into that 2% target or not.
Really, to me, that's the nuance. Like, so a big part of, I think, the last year is like the market gets divided into camps, and you have to kind of declare your allegiance. And I really think that the best traders are those that can hold like kind of two opposing opinions in mind at the same time and understand it's a messier world than just like deflation or inflation, and that's it. And so to me, that's really what you're getting at is like oil is off doing its own thing. I think it's helpful, again, that we're in that market and we can say like objectively that oil is doing its own thing. It will impact headline inflation. It will impact the Fed. The Fed keys off of oil. They key off break-even inflation rates, which key off oil. So all these things are connected and we know it. And we also know that there's a reason we could see oil fall. And we also know that, and it's a point we make to our clients, oil is the only commodity that can do this. It's not copper, it's not gold, it's not cocoa. Oil. Oil is the one commodity that can throw us into stagflation, that can bail us out of an inflationary issue like we're seeing right now. It's by far the most important global commodity still. And if you think about, like, some people say copper is the strategic commodity or is becoming a strategic commodity, but like, if copper prices spiked, people just stick with ICE vehicles. We have all the infrastructure and everything in place. If oil spikes, there's no ability to freely frictionless transfer back over to electric vehicles. We're not there yet. So oil is the 800-pound gorilla in commodity world, number one. But on the other hand, the other thing we look at is housing. And that's where I think housing has been a source of real inflation reacceleration, which is what you're getting at here. We spend, I'd say, as much time looking at housing as we do oil because it's primary to our recession call. And what we saw coming into the year is basically a reacceleration of the housing market. I think what you had was rates go from 5% on the 10-year down to 3.8. You saw mortgage rates go from 8% to roughly 6%. And the housing market responded. The new home construction responded in single family construction, and pricing, rental pricing responded. All these things are because the debate really at heart was, are we just getting stale shelter inflation data, or is there actual reacceleration because of financial conditions and things the Fed signaled back in like November and December? And in our view, up until March, we were giving it the benefit of the doubt that this is all just lagging stuff. But by March, we were getting important data that the rental market and the housing market was in fact reaccelerating. So that's core inflation. We see, I think, real problems for core inflation because of the housing market in this current environment. But headline inflation is going to be held back by oil. And there's going to be this kind of, I think, these two opposing forces, one inflationary, one kind of disinflation or deflationary in oil. And then it comes down to what's the Fed's motivation and which one they're going to weight more and how they're going to navigate this.
Hey everyone, this episode is brought to you by Avalanche. Avalanche is a leading network of blockchain, which is giving access to some of the world's largest financial institutions to experiment and build on crypto rails. I'm a big fan of Avalanche. I've talked about it on this program before. The Subnet architecture leverages some of the best parts of IBC over in Cosmos, the interoperability protocol, and the rollups on Ethereum, with the result that if you're a financial institution, you can build on something that's highly interoperable, but also customizable and scalable. And it's not just me. Many of the largest institutions in the world are taking notice. And a couple examples of folks who are building on evergreen subnets include Onyx by JP Morgan's. They leveraged an evergreen subnet to explore how tokenization can revolutionize the asset and wealth management industry. Citi and the DTCC digital assets are testing private market tokenization on the Avalanche Spruce testnet with Wellington and Wisdom Tree. So again, some of the largest financial institutions in the entire world are building on Avalanche. Avalanche Evergreen provides a suite of institutional blockchain deployments, customizations, and tooling designed to address company-specific and industry-wide requirements for financial services. So join the institutional investors that are choosing Avalanche today. Go to avax.network/evergreen. Again, that's avax.network/evergreen and join the revolution. Avalanche, thanks very much for making this episode possible. Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions into Web3. So you guys have heard me talk about Larry Fink talking about tokenization. You've seen the clips on CNBC. You know that Larry and BlackRock are very, very excited about this idea. And the reason for that is they're looking at these trillions of dollars of off-chain real-world assets. They want to digitize those and bring them on-chain, which is going to be a massive opportunity. But in order to do that, they need a compliant L1, and that's where Mantra comes in. Mantra's been steadily climbing the ranks and now stands among the top 4 RWA projects on CoinGecko, which is representative of its rapid growth and influence in the tokenization space. Mantra's built using the Cosmos SDK, so they have some very cool stuff out of the box. They've got IBC interoperability. They also leverage CosmWasm smart contracts. Very cool design from an architectural standpoint. The next phase on the blockchain's testnet is Hongbai. So that's launching soon. So if you're a dApp developer or something like that, there's a lot of very cool opportunities for you. And I highly recommend that you click the link at the bottom of the show notes. I don't know that I sent you. Thanks very much again, Mantra, for making this possible. And again, guys, click the link at the bottom of the show notes.
Totally. That's definitely how I'm thinking about it too, is, do they just cancel each other out and we just stick around this 3%, 3.5% range? Or do you think we can get back to 2%? And if so, like, what's your playbook for us even getting there if owner's equivalent rent is so lagged that and so sticky? And I know you break apart existing rents versus new rents and that dynamic. I'd love to hear a bit more about that and whether that stops us from getting to that 2%.
Yeah. So if you go to core PCE, which is what the Fed says they're watching, oil, people want to say, oh, well, oil will flow into core and stuff like that. And it's like, not really, not on the time frame we're talking. So oil doesn't matter when it comes to the core inflation argument. So I think policy might react and markets might react, but the academic truth of that we're having this like 2% target and things like that, oil doesn't matter. So the core PCE, what matters is the housing market. It's like 40%, 42% of core CPI, not quite that much in core PCE, but a major part, almost a quarter of core PCE. And when I look at it, I don't see a path back to 2% anytime soon on core PCE. I don't even see a path to exiting this year at the Fed's Q1 PCE, core PCE target, which was 2.6%. So That was what the dot plot suggested in Q1 SEP. In order to get there, we would need to have month over month core PCE print at something like 15 basis point gains every month for the rest of the year. And we haven't seen that at all this year. We haven't seen anything like that. We just got a 25 basis point month over month rise in core PCE. The market celebrated it as if it was a major disinflationary data point. But if we printed at 25 basis points month over month for the rest of the year, we would exit 2024 at 3.5% core PCE, just based off base effects and what's coming in the back half of this year. So to me, that's the very sticky issue for the Fed, is that I do believe the financial conditions that are loosening are flowing into the housing market and reigniting the rental market. The idea that you brought up, which is that why do these rents and housing inflation seem to lag? That's the big point. That's been the point of contention for a lot of people. The reason that happens, which I feel like I've explained this a lot of times, but I'm getting better at it, hopefully. The reality is, like, it's not a lag. It's not a lag per se. It's an economic reality. The reality is, if you're a landlord and you have an apartment building with you get a tenant off the street. Let's say your existing tenants are paying $1,500 a month. And then the market shifts, and you get a tenant off the street, and the market's gone up. You're going to charge them $2,000 a month, and one of your tenants who's in your building now comes up for renewal. You're going to push their rent up, but everything we know about the world says they're not going to get to push that tenant's rent all the way up to market rents immediately. And even if they really were able to do that, it would be a process that took place over time. And so the CPI for rents, which owner's equivalent rent tracks, so it's a technicality. You should just all put it as shelter inflation when we talk about it. The CPI is looking at the new rental market, which is about 20% of CPI rents. And then 80% are all those tenants who are still down at $1,500 a month and need to get their rents gradually increased up to the market rents. So if the market rents start, the new market, the 2000, say that rate slows from going up 5% a year or 10% a year to 2% a year, well, the existing rents will catch up faster. But if you get a reacceleration, that $2,000 a month becomes $2,200 a month, the existing rents just never catch up to it. And that's been the situation that we find ourselves in, is that the new and existing rent convergence, which is when you would see this major disinflationary fall in CPI calculated CPI and rental inflation, that hasn't come to pass because we're getting the reacceleration in the new rental market. So it's really like, if you picture in your mind like a moving average convergence divergence, you need to see the new rental market come down, decelerate while existing rents hit it. And once that happens, they converge, and then the slowing new rental market becomes your CPI rent number. The upshot of all that is you have a lot of people who want to ignore existing rents and ignore the renewals that are going on in the background and pushing the rents up. So they'll grab things like Zillow or something that looks low, and they'll put that into the CPI. And it misses that whole dynamic that there's a bunch of tenants who are getting their rents raised, probably the majority, according to the CPI, 80%, who are having their rents raised every year, every 6 months, whatever it is, on schedule until they hit the market rent level. And we haven't gotten there yet. All of our analysis, we've gone through all these different, it's still a mystery to commentators and even BLS economists you talk to. It's a mystery of what approximates the best approximation for CPI rents, new rents. And we went through a number of different machinations to say, okay, when would this legendary convergence between new and existing rents, when would it take place, using things like CoreLogic, single family, using things like, which is something the BLS has called out as very accurate in their white papers, using things like Zillow, single family, Zillow family, all homes, Zillow family, Zillow multifamily, and the NTR, which is the Cleveland Fed's approximation of new tenant rents. So we go through all those, and none of the ones that are privately created point to a near-term convergence between new and existing rents The NTRR, which is the government's, the Cleveland Fed's and the BLS's creation, suggests we've already had that convergence, but it just doesn't map onto reality. If that's true, then you would have seen CPI rent already collapse. We haven't seen that. So that index was already revised last year. And I think it's wrong again. It's got some wonky stuff. If you, again, talk to the BLS economists, they don't trust it. A lot of this is technical, and a lot of it is it sounds in the weeds. I think you have to be in the weeds to have any confidence about this stuff. And so that's my view, is that shelter inflation is not going to come down in the way that the disinflationists need it to, that the Fed needs it to hit their Q1 targets. And so the question becomes, what is the Fed going to do about that?
I'd love to tie this into, obviously we have the June FOMC meeting coming up, but it sounds to me like the two arguments, you have the super core inflationista argument, which is that these components that you just described are super sticky. It's not going to allow the Fed to get to their 2% target. They're not going to ease if they don't get to that target, because it makes them lose credibility. The other side of the argument is, look, these are very in the weeds components, but if you look at the big picture, like we just talked about with headline oil, other global economies are starting their rate cutting cycle pretty soon here. That's going to have some pretty big impacts on, currency differentials and that sort of thing. So, we need to look past these small final components and start cutting, or at least start leaning towards cutting more so. That's what I view as the two, components. So maybe we can use that framework and shift to the June FOMC meeting. And what do you think happens? For me, I feel like one of the most important things to signal that will be the updated dot plots, but I'd be curious, what you're looking at, and especially those two lenses.
Yeah, I like that frame. I think it's accurate. I do think the dot plot is the real pivot point, because you have to have real rose-colored glasses on to see to maintain your core PCE target of 2.6% by the end of 2024. If you're a Fed member, maybe they will do it. The one thing that argues in favor of that is that Powell continues to make the case. He'll describe this new and existing rent phenomenon that I just kind of walked through. He'll describe it at press conference. He just did it in May 1st press conference. And he'll say, well, we got to have this, and this, and it takes longer than we thought, but it's going to happen. We know it's going to happen. And the problem is, he was saying that back in June of 2023 in front of Congress. He's been saying it for a long time. And so maybe the Fed, though, just says, hey, we know it's coming. We can look through it. And maybe you get an uptick in, that's why Friday's payroll report is going to be so important, because you're going to start getting the Claudia Sahm wing of the Fed intelligentsia, that if we get even a modest uptick in unemployment, who are going to say we need to cut rates to avoid a recession. Then it goes back to the values trade-off, which is between inflation and growth, and or employment, I guess better said. And the third factor, which never gets into the conversation, but is really operating, I think, with primary importance if you just take the Fed at what they've done, is financial stability, which is what you bring up as other central banks are going to be cutting during this time. There's an election out here in November. The Fed would like to, I think, they don't want to wreck the markets in front of the election. And I've gone back, there's not a whole lot of cases to study, but if you study every incumbent presidential election year, the stock market's up big. And that's because I think you get this kind of everyone rowing in the same direction. We want to try to keep the train on the tracks, keep everything steady. And that is all under the rubric of financial stability, which is another one of those Fed mandates. So you have inflation, which I think that's already, you're going to have to mark that up. Unemployment at this point in time, it has trended higher, but it's due to a larger pool of labor and labor supply, probably immigration to a large extent. So it's been what I would call benign loosening of the labor market. And then you have the financial stability. And I think when the Feds come in, they ended QT earlier than most anyone expected, far before they had ever suggested they would, given where we were on a reserve level and liquidity and things like that. So to me, it shows me that financial stability, which is code for markets, has been the Fed's key primary driver. And so with that in mind, I have to lean towards they're going to come out dovish in the June meeting. That's what I lean towards. But the devil's in the details. And I want to see where that core PCE number goes with the dot plot or with the Fed's estimates. I want to see where the committee members, they will have to mark that up. There's no way around it, in my opinion. So they'll have to mark that up. And when they mark that up, they, let's say, like in my opinion, we're going to exit the year at 3% core PCE probably.
Mm-hmm. Yeah.
So if you say we exit at 3% core PCE, how many cuts can you really justify in your dot plot? It would be really weird to start cutting rates at 3% inflation, given everything. Can they justify that? I mean, maybe. I think last time was a pretty dovish. The last dot plot was very dovish, given the data and the projections and what it suggested. We did a whole analysis on that. But I think they'll price at least 2 of those cuts out, maybe all of them in the dot plot. Probably we'll have 1 cut in there. They'll probably put core PCE at 2.8, and they'll probably mark unemployment up or hold it steady. Those are the key things to watch. And then to watch the real rate of interest, which is what their implied Fed funds rate is minus core PCE. It's at 2% right now. Every time that's gone down, the market's rallied. So I think that's the key. I think they'll probably try and hold that steady. We're going to start looking ahead to 2025 and see what the real interest rate is projected to be in 2025 and how many cuts come out of the market in 2025. Those are the things to watch. My guess is that if anything, the Fed's going to be more dovish than we expect. I think it's much better to react to this than to try to trade in front of it, in my opinion, because what we've seen is, if the Fed comes out and they hawk it up and they price all the cuts out, and if you want to get more conservative on equities, we'll probably get a sell off. You'll miss the first couple percent, but I think you'll have time to get out. And if they're dovish, the market keeps moving on the current trajectory, and you're not getting chopped up trying to be underweight ahead of it and things like that. So that's how I see it. It's a tough setup. I think the data is going to eventually show up as, causing the Fed to hold off on cuts. I don't think it's ever going to materialize unless there's economic weakness. But maybe June's not when they take their medicine. Maybe it's September or something like that.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back Permissionless. We're going to be doing Permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for Permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
Yeah, I do find it quite funny how almost every FOMC meeting we go in expecting Powell to drop the hammer and finally be hawkish, and that just doesn't really seem to formalize. And for me, a big tell was this QT taper that you keep mentioning. When I dig into the mechanics of it, it seems ridiculous to taper. Like they have the standing repo facility. So even if there was any sort of stress in their taper, that could take it up. We see no stress in money markets. Like if you measure SOFR to interest on reserve balances, there's no stress, plenty of reserves. It doesn't make sense unless you look through this lens of, and we can tie this into the fiscal / treasury side of things and more big picture views. Is, to me, it seems like they're worried about these bigger picture issues, like debt, for example. We've talked a little bit about just the sheer amount of debt that needs to be issued, and when you look at just how unstressed the bank reserve system is going into this QT taper, it made no sense to me to do it, but they still did it anyway. So shifting that into some of these longer term discussions we've had around debt, fiscal dominance, treasury, that sort of thing. My big question to you is, who is going to buy all this debt in a more secular, less so than like a cyclical, like recessionary rotation or something like that? But like, who's going to buy this? And is that QT taper sort of a bit of a signal about where the real concerns lie?
Yeah, I agree with your assessment. From what I can tell, they're just they're terrified of QT from 2019, and they don't know how to measure it, but I still think they chickened out pretty hardcore in the taper here. I mean, they had pretty much made the case that reverse repo was excess liquidity. I think that was the right case to make. That it was analogous with bank reserves, and they were inert more or less. And you heard Waller talk about it, I think, at the Brookings Institute, that these reserves this is like inert reserves that nobody really needs or wants. And so they stopped pretty early with that. I mean, they didn't stop. I keep saying they stopped. Some people could be like, no, they're still doing 25 billion a month. But like, the truth of the matter is that they are reducing their balance sheet. And so if you look at it from that perspective, then I guess then it's still going on, and they could theoretically keep it going for years. I don't think they're going to keep it going for years. I think they'll end it sooner than anyone expects right now, just like they tapered sooner than people expected. So if a lot of people, I think, stand in the Fed's shoes and they say you need to use QT as a tool to impact the long end of the curve. You need to, force, maybe actively sell bonds versus just letting them roll off your balance sheet. And you need to force the Treasury to try to issue duration and swamp the market with duration, and have this kind of reckoning that they want. And at the same time, that's the effective way to run monetary policy, because it would cause mortgage rates to rise. The whole housing reacceleration I described would have probably been stopped if they would have caused the back end to rise. So there's a whole hopeful idea that they're going to do that. But maybe they never saw QT as that tool. Maybe they just thought QT was basically a way for them to sop up excess liquidity. I never really thought QE or QT worked through the liquidity channel. I thought it was all through the duration channel. So basically, if that's what they saw, then that's how they see the world. They didn't want to impact monetary policy too much from it. So what does it all mean? I don't think anyone wants to have to deal with issuing all that duration right now. The Treasury doesn't want to do it. They haven't wanted to do it. They finally came out and they had they forecasted a pretty big duration issuance with the last QRA spinning it forward. But then QT is ramped down, is cut down by 35 billion a month, which basically will take a lot of that supply off the table. So I think that the Treasury and the Fed are, whether they're in communication, and this is some kind of, it's not like a conspiracy theory. I think these are just arms they're both extensions of the federal government. They see this as a reality, that we don't want to try to issue that much paper. If you go back to the Treasury Borrowing Advisory Committee, the TBACs, their guidance, why did term premium rise in, I believe it was the Q3 QRA. They if I'm not mistaken, maybe it was Q4. And they addressed it. They're like, look, who's going to buy this debt? Like, when people are backing away from the market, bonds are no longer negatively correlated to equities. They brought up all the stuff that we've talked about. And so I think that the Treasury knows it. The TBAC knows it. The Fed knows it. So ultimately, who's going to buy the debt? I think the Fed, the Fed's balance sheet is like 27% of GDP right now. It's still, I believe at this moment, above the highest level it was at the previous bout of QE, whatever's at QE3, I guess. At the end of QE3, and then it comes down versus GDP, and now we're right back to where we were. So what I see are these kind of cycles, these cycles where each time we get through one of these cycles, the Fed's balance sheet, which is ultimately their role in the treasury, in the debt markets, the U.S. debt markets, it increases as a percentage of GDP as we go through each one of these cycles. That in these next crisis, they kick on QE faster than they did in the previous cycles. And, who knows exactly what that looks like. But I don't see us getting out of this without the Fed being more involved in the debt market. I think foreigners are modestly decreasing their buying. There is some banking regulations that people talk about, which I haven't gone down that rabbit hole completely.
Like the SLR and that sort of thing.
Exactly. And so like maybe that's something they use. There'll be a lot of levers they pull as we go through this on a secular basis. And so it's not like the Treasury is just going to give up the fight and be like, we screwed up. Like, we spent too much, it's been too big of a deficit for too long. Now we're just going to pay 7% interest rates. It won't be like that. So it'll be an ebb and flow.
Yeah. I feel like the worst trade in the world is thinking that the Treasury and the Fed are backed into a corner and they don't have some sort of facility they can spin up. I mean, you look at like BTFP and that sort of thing. And so I totally agree. There's always like, it's a political decision really. And they can, QE, everybody knows that word now, so that's a bit more difficult to sell. So to me, the argument of something like that SLR exemption or something to basically stuff banks with treasuries makes a lot of sense to me, but it feels like something needs to occur. Shifting to, say, the next 12 months outlook, to me, it feels like a lot of the current controlling of debt issuance / debt buying, the current facilities and what they're doing right now has about, I don't know, like a 10-month time span, and then it feels like something needs to come on, whether that's starting to signal towards QE coming back or that sort of thing. What do you view in the next 12 months?
Well, I mean, the first low-hanging fruit is to just end QT outright. So, just like we took 400 billion off of the table, then take the remaining 300 billion off the table, annual funding hole. We've heard already that in all the QRA, TBAC letters to the Treasury, they talk about, we used to try to use 20% bills, 80% duration or coupons. And there's really no reason for that. It's kind of like the inflation target. It's like, well, why are we even doing that? Like, why can't we do 30%? If you do the math, which we've done the math and projected out where we go under like a 50-50 split, issuance split, like the total stock of debt outstanding, it would be a long time before we got to like 30% T-bills. So I'm not recommending that as a strategy. I'm just saying that's a possible lever for them to pull. So there's all these paths, all these steps along the path. I'm not a big fan of, like you can say that I think what we're doing fiscally is unsustainable. And I think there are really negative consequences in the here and now. But I was warning people that this year, don't be shorting bonds too aggressively here, like at 4 or 5 and above. Like, let's not be shorting bonds here, which I saw that as a popular trade. And it was like a quote unquote no brainer. And here we are, we're back yields diving, and it's never a no brainer in my opinion. It's just you're fighting City Hall. And so, yeah, I think it'll be, I don't know. You'll see regulatory changes potentially. I think a recession will pull yields down too, if and when we have one. And I think it would happen if we decided to do anything about closing the ongoing deficit. So let's say that we get through these election and all these tax proposals that are being, let's say Biden wins re-election and we have some of the tax proposals are pretty nasty. If we were to get anything that looks like that, I think you would have the potential for a pretty nasty slowdown, in my opinion. And so there's a million different ways it can go and so much uncertainty. It's hard for me to exactly speculate on what's going to happen.
In a report that you put out a couple of days ago, you had mentioned something that I definitely resonated with, which is just around your biases as an investor and a trader and an analyst and a strategist, around being generally inherently pessimistic. A lot of the things we talked about in this interview are things that are pretty big picture. They're definitely easy to fall down the rabbit hole of, I don't call it doomerism or something like that. But I'd love to just hear a bit more about how you manage that. What are some of those systems you have in play? And just, any tips for people that are in the weeds on this stuff that could easily seem like, oh, the world is falling apart, to keep that in check.
Well, I mean, on that front, just remember, like, there's been, you could go back to any point in American history and find really intelligent sounding commentators warning about an imminent collapse of the empire or things like that, or any number of kind of like calamities or whatever. And so try to be just like you're skeptical of the government or whoever. If you're like, if you go down that, be skeptical of the commentators you listen to. Like, for instance, all this fourth turning stuff, it's really like very weak. Like, I've read the book or listened to it on an audiobook, and like, there's most of the doomer stuff is like, what was their track record coming out of the GFC? Have they been preaching the inflation gospel since before the COVID panic? Because honestly, before COVID, there was really no reason to be worrying about inflation. So unless you saw these material change in the commentators' views coming out of out of COVID, like, then they're probably just perma bears that have been, you don't listen to them. Don't be the guy who never got in the market after 2008 because he read Zero Hedge and tried to buy corn or something. Don't be that guy. you know, I was that guy back in '08 for, but then if you're in the business, you can only persist in that state for so long, and you have to figure out, I either can be right or make money. I can either have all my theories come to pass, or and just go down that rabbit hole and dig my heels in, or I can accept that I'm missing something in my mental model. And so that's the first thing, is be skeptical of these people you listen to. Practically speaking, what I always say, and we mean it, it's built into all our models, is we build conviction on fundamentals, but we manage risk with technicals. If the price action is telling you something that's going against your belief, you better listen to it, and you better have a system to allow prices to get you out of a bad trade, whether on the upside or the downside. And so to me, risk management, and that is ultimately all comes down to price action, because I could come up with this really impressive story about how oil intersects with the debt market and how the Fed's monetary policy cancels this much out and where we're going to go with inflation. Like, I can come up with all that stuff, but if the market, then my output is like stocks go down, but stocks keep going up, you better have a system that keeps you in line with that major trend, because you can do all this macro analysis and miss the big picture, and you need to have something to get you back on track. So we build that into everything we do. We test it. If we have a fear, if something comes out, we had this Hindenburg omen fire, we had a really nasty day on this NVIDIA earnings day, which I think there was something going on there. We test it. How bad is this? What are forward returns like? How does it look versus your control group, what the market normally does? Go back in time, and so there are some momentum signals that were positive that we got 6 months ago. How do those interact with this stuff? What's sentiment? What's positioning? You need to have a set of systems and objective indicators in place that are purposefully built to counteract that bias. And I think a negative bias is probably the worst one you can have. Like, you don't meet successful, pessimistic entrepreneurs. You don't ultimately meet, like, you'll see like a Stan Druckenmiller, who was a client of mine at Ned Davis Research. And like, I when I worked over at my old shop, and same with Paul Tudor Jones and these guys. And if you listen to them come on, I've been to Tudor, I've been to that hedge fund and presented to like their energy group and stuff like that. They're really smart guys. I love listening to them. Druckenmiller was just out talking about how government spending is crowding out private investment. And I think that's true. And I retweeted it and gave our thoughts and stuff like that. But when you look at it, he doesn't invest like he talks. He's talking like a doomer, but he's buying NVIDIA. And that's because they know what I just said is true, is that they can trick themselves, but ultimately they're in this to make money. And ultimately, price does rule everything. And if you're going to manage risk, you need to do it through price and through technicals. No matter what your overarching fundamental story is telling you, you can build that conviction up with fundamentals in macro, but ultimately price has to be your risk management and keep you out of trouble.
That's really great advice. Really well said. I think that's a really nice place to leave it. Thanks, Warren. And again, your 314 research I totally agree. It's as systematic and pragmatic and statistically robust as it gets, and that's a really nice way to manage those biases you just mentioned. So really appreciate those words, and I hope a lot of listeners really use that as a bit of a wake-up call if they're a little too doomery. But that was really great. Thanks for joining us, Warren.
Hey, thank you for having me.